And it's always good to find money, right? Okay, so I'm going to use high technology here. I used to be in IT, so I'm going to see if I can keep up. Can people see that up here? Yeah. Then we'll leave it up, because they're taking camera of this, so video. All right, so let's move on. So what is a comprehensive financial annual report? I'm actually going to come back to this in a couple of slides, but I want to actually talk about some of the things that Mike talked about, how to fund a bank, and then I'm going to go back to that first slide, so a couple of minutes. You can't hear? All right. All right, I'll go slower and louder, because it's important. So what the city does to raise money besides taxes and investments is it issues bonds, right? So a bond could either pay for a bank or it can pay for existing obligations. And there's three kinds of bonds. You've got general obligations, contract and lease debt, revenue bonds, and you've got the different agencies that can issue bonds as well. Now, one of the reasons that you're going to find out why it's not $6.5 billion and it's much more money is because that $6.5 billion doesn't deal with these agencies that are listed up here. So there's a water and sewer, an aviation department, not all the same thing, water and sewer, and then there's an aviation department. There's a Philadelphia Gas Works. Well, that actually does have the pension fund in the $6.5 billion. But there's Philadelphia Schools, there's a parking authority, which is a great place to park your money, by the way. And then there's all kinds of other agencies. There's 8 separate entities which aren't even up there. And they can issue these kinds of debts, either with taxpayer approval or sometimes just on their own. So this is how the city gets some of its money. Now, the city actually has a pretty good credit rating. Most of their bonds are rated A or at least a BBB+. So the city is actually doing much better than, say, states like California, which was as bad as Greece with CCC ratings at one point when it was floundering in the crisis. But the problem is that you're just about out of your statutory limit. So you're about 79 or almost 80 million away from your limit, and then you won't be able to borrow more unless the city approves a higher limit for bond borrowing. So there's 1.622 billion allowed, 1.543 billion outstanding tax-supported debt already, and you're paying 2 to 5% interest on this. So it's not only that you're hitting the limit, but you're paying interest on bonds, which, as we'll see later on, the city could create its own credit instead, and you wouldn't have to pay any interest at all. So the real question is, and you should keep this in the back of your mind as we're going through this, if the city can issue debt in the form of bonds, why can't it deposit tax dollars into a public bank instead? And the cousin question to that is, why can't it just take less risk by putting money into a public bank instead of the risky kind of investments that we're going to see as we go through this? So now I promised I would explain what a CAFR is. Okay. So this is a comprehensive annual financial report. It's not a budget. A budget is a selective funding of X accounts from Y resources for 1 year. A comprehensive financial report is all income, investment, all the assets of the entity for the entire history of the entity, really. It's not just 1 year, it's everything for the whole time. So the big difference between the two of them would be the annual budget to operate your home versus a statement of your total net worth. So it's a big difference. So when people say that the budget, you know, we can't afford something, it's outside the budget, well, you got to take a look at the whole net worth and see what the city really has. We'll get to Q&A a little later on. So nationwide, there's 184,000 of these. As of 2007, you can go on this little website, CAFR1.com, which I got to warn you is a little flaky, but his numbers are good. So there's 184,000, maybe there's 200,000 at this point, they keep growing. So every government entity has a CAFR. They describe the assets of that government agency and pension. They tell you about all of the the accounting procedures that they use. Now this gets tricky too, and I was hesitant to put this in here because it's pretty controversial, but actually the way that CAFRs are calculated, they use generally accepted accounting principles. And those are not as straightforward as it seems. And the way they've been tweaked in the last few years is they make it seem like entities have less money than they used to seem like they have. Just to give you a quick example, I did a little analysis of Detroit, and I found Kevin Orr, who's now the emergency manager. Even he admits that under the new GAAP rules, which are going to take place in 2014, there's $2 billion less for Detroit than there would be under the old rules. $2 billion. So it's just the way that it's accounted for, because you have to take future liabilities into account in a much greater degree than you used to have to do. So this is a new GAAP, so you can argue whether that's a good thing, it's prudent and so on, but it does have the effect of making entities look like they're poorer than they used to be. So that's important to keep in mind. And another thing is I spoke to one of the VPs at Moody's, who's actually in charge of press relations, and I told him I was a big press reporter, even though I'm a blogger who doesn't get paid. But he did share some information with me, and he said that they have standardized their procedures so that they now look out 21 years or something on every city and every state. They wanted to do the same. So they used to do much less on most states and cities when they evaluated their creditworthiness. But now they wanted to standardize, and they took the longest common denominator, so they went out 21 years. So that means they're looking at liabilities way out there, and they're basing it on current revenue projections as of the current time. So they're not accounting for raises in the future, for new sources of revenue, and so all of these things come in. And there's one other thing. When they came out with their last Detroit analysis, when Moody's came out with it, the next day there was an article in Reuters, and they said that, you know, hey, this is not right, because they're using bond returns from the current yields of bonds, which are extremely low because of the Fed's QE. So that's not what's going to happen in the future. In the future, we're going to have much higher bond yields, and so it's unfair to project years out based on these low yields today. All right, so I don't want to get too deep into the weeds about that, but you can go to these sources over here. And by the way, you're all going to get emailed this presentation, so don't feel you have to write this down. You can go to these sources in the Philadelphia.gov site, look up the CAFR itself, look up the financial reports. Everything I say, I'm trying to reference with page numbers, so you can go back and check my work. I don't want you to take my word for it or anybody else's, but you can see for yourself. Okay, so now, important thing to keep in mind here. We're not trying to change the way things are funded in the city. We're not concerned with cutting teachers' salaries, eliminating schools, doing all of these things that, you know, frankly, we shouldn't do any more of. What we're concerned about is changing the investments. We're not changing the way that the money is spent. We're changing the way that it's earned on investing. So we're trying to preserve the pensions. We're trying not to cut back on the pensions by changing the returns on investments. So the questions to ask as we go through this, and on every slide, can investments in a public bank be more prudent and safe? Can they be counter-cyclical? Are they able to provide consistent returns? Well, we know we don't get consistent returns from the stock market. Are they, well, when I say counter-cyclical, do they go up when the market goes down and that kind of thing? And North Dakota, by the way, was the only state to have a profit during 2008 when every other state was having a huge deficit because of the crash, and they have a public bank. Are they supportive of local community and job creation? Are they fiduciarily responsible? I think I'll leave that to the end because there's a kicker that some of you may not have heard of that has to do with the new FDIC policy, but I'm going to leave that till later. Okay. So now, although the money is going to be used throughout the year if it was in a public bank, the usage of that money, let's say it was public money, is predictable. In other words, you get your tax revenues once a year. and then you spend them in a fairly predictable way. You know, that doesn't change that radically within a year. So you can count on having a certain deposit base throughout the year. And this is how North Dakota does it. They take all the taxes and they put them first in the bank, and then through the year they gradually spend them, and that forms a deposit base. And you know, it's a liability of the bank like any other bank, and so they have to be very prudent. That comes back to that. And not make foolish loans. It's a bank. It's not an economic development corporation or slush fund or anything like that. But it's a bank, and it does conservative loans, much more conservative than anything on Wall Street. So it's fiduciarily responsible. So for these reasons, we think a public bank is a better strategy. All right, so now let's take an actual look at what we've got. Now this is where the $6.4 billion comes from. These are basically the two pension funds, the Municipal Employees Pension Fund and the Gasworks Pension Fund. And if you add up all of the investments, the main categories of them, you come out to nearly $6.4 billion, except that this is the end of fiscal year 2012 in June. We're now in October of 2013, and I looked 2 days ago, and the 2013 CAFR is not online. So they are overdue. And I'd like to know why, by the way. They really shouldn't be overdue. Now, Detroit is another city that's overdue, and they are in emergency bankruptcy proceedings, so I hope it's not because of that. But I think based on the stock market and the various investments that they have, it's probably a good deal more than $6.4 billion at this point. But let's go with their number from over a year ago. Okay, so let's break this down a little more. So Mike was talking about the foreign currencies. Well, here's a few of them. It's actually on page 49 on the CAFR report. So these are the biggest ones up here. Obviously, euro currency, Japanese yen, pound, Australian dollar. And then you've got all others, and all others is bigger than, I guess, almost all of these combined. So, oh, and this is in thousands. So let's add 3 zeros here. This is 613 million. Not 613,000. So you've got over $500 million in foreign currencies. You know, so the euro go up relative to the dollar. Is the Japanese yen going to be devalued because they wanted to spur exports? You know, you start to get into this kind of morass of asking these questions, which is what the Board of Pensions and Retirement Funds will do. And you ignore the big picture. So when you're locked in this paradigm, you start to forget that, you know, there's options. You become too enamored with getting the best returns on your investments instead of thinking, well, is this really a good way to invest the money at all? So as Mike said, you know, this is not even in the country. So $613 million of that $6.4 billion, that's not even in this country, that we're paying somebody to manage, that's not helping Philadelphia, not helping the state, not even helping the country at all, may even be competing because it's supporting another country exporting goods to us that we could be manufacturing here or doing something with. So why are we doing this? Another risk, and this one just kind of blew my mind, this is a broker-dealer repayment risk. Apparently what Philadelphia is allowed to do is they're allowed to loan portions of their portfolio to a broker-dealer, and what they do is they say, well, we've got these X millions of dollars, or maybe billions of dollars, and now in our portfolio, and what we're going to do is we're going to speculate using that as collateral, using the Philadelphia money as collateral, and that way we make money, and we'll pay Philadelphia back 102%, in other words, 2% more than Philadelphia had when it had loaned them the money, plus interest for the time that it was loaned out. So, well, you know, this is pretty risky. And they even say at the bottom here, securities on loan as of June 30th are unclassified with regards to custodial credit risk. So they don't know. How risky is that? You know, it's just out there. It's unclassified. But you see it's at 102%. And there's interest on that. So this is really securities of securities, so it's risk squared. So it's bad enough you've got a major portion of your pension fund invested in securities and equities, which can go in all kinds of directions. But on top of that, you're loaning it to other people who are doing their own speculating. And so you've squared the risk. All right, and now let's look a little deeper into what these hedge funds actually do, or actually what the discussion is about them. So this is just a tiny snippet of a whole slew of minutes that typically goes on in the Board of Pensions and Retirement Investment Committee meetings. So these people get together and they say, well, what's the best investment, what's the best way to invest that $6.4 billion? And you know, they discuss the past returns and they say, well, you know, is this fund doing better than that one? So, you know, they ask, I won't read this whole thing, but one of the things that came up at the end of May, a fund was up 13%. In 2012, they were down when the market was up. Well, this is a hedge fund, so sometimes they go down when the market goes up and up when it goes down. So we're going to talk about whether that's a good strategy in a minute. So they asked, well, how are they doing this month? So Mr. Handa spoke to Michael Martino, who's the manager of this fund, and Martino said they were doing fine and would not give specific numbers. Well, okay, we're doing fine. If you called your broker and he wouldn't give you specific numbers, I'm sure that would be reassuring, right? Over a 4-year period, they've done very well, whatever that means. Over the last 6 months, the results have been fairly consistent, whatever that means. So they made a motion to allocate $50 million more to this Mason Capital, the trustee of that fund. And by the way, there's 100 of these. Mr. Stagliano seconded it. There was no discussion. All were in favor. There were no oppositions or abstentions. The motion passed. So they get together, and to recap, what they do is they invest in funds based on past performance, which does not guarantee future results, right? So there's no guarantee of future performance. So they invest in hedge funds that go both long and short, even though most of them never beat the S&P, and we're going to see a little more extreme example of that in a minute. And they charge high fees. So in the period being discussed, the pension fund returned 12.8%, which isn't bad, except the S&P was up 20%. So you're paying a lot of money, you're not outperforming the market, you're having big, you know, highfalutin discussions like this, which frankly don't help you outperform the market. And then eventually you have assent to motions without discussion to remain team players, which is kind of a groupthink. And above all, it's not investing anything in the local community, and it's not creating jobs for the local community. So my question is, do you feel safer doing that than in a public bank? Okay. So here's a specific example. I have to give credit to Mike for showing me this one. This actually came out in the Philadelphia Inquirer, and this was a state hedge fund, because remember, this state has CAFRs too. And this was a hedge fund, I have to apologize, it's on New York's Park Avenue, so don't blame me even though we're from New York. But it was invested in the Pennsylvania State Employees Retirement System. So they gave Tiger Management $250 million in 2012, expecting that they would get 8 to 12%. That's what they were promised. By the way, who does that remind you of, 8 to 12% a year with no risk? Doesn't that sound like somebody who just, yeah. Bernie Madoff, right, exactly. So that would be $20 to $30 million a year without the usual up and down volatility, sure. So instead of performing to hype, their Keystone Partners portfolio lost $1 million in the first year. So they didn't make 20 to 30 million, they lost $1 million. So one of their managers, of which there are several, he bet on gold, which went down in 2012, and that basically canceled out all the gains and the other things. So you have a hedge fund, and within that hedge fund you've got multiple managers, and outside of it you've got people on the board, and pension board and retirement funds. They're deciding which hedge funds to buy. And then you've also got broker-dealer relationships where you've loaned your portfolio and they're deciding what funds to buy. So you've got all of these layers of decision-making, which basically negates the positive returns of the S&P and provides a whole slew of middle people, a big slew of investments, fees. So, you know, it's quite a racket. I really should be in this business. So they lost, when the S&P rose 13%, they lost money. And most S&P funds, by the way, charge less than 0.2%. So let's see what we're going to come back to that in a minute. Okay. So forget about the crazy funds. Oh, well, I do want to say one more thing about that last slide. So Matt Taibbi, and I have to give credit to Mike again for showing me this article. He wrote in Rolling Stone that most hedge funds underperform, even though they sometimes have incredible gains for a year or two. So he gave an example of a hedge fund in Rhode Island where they had a 41% gain in 2010, and the next year, 2011, they got a minus 0.54% return. Now, 2011 was an up year, so they lost money. So most people are starting to get in to understand that these hedge funds don't outperform on a long-term basis. So there was actually Warren Buffett made a bet against these protege partners. It was a hedge fund in New York, and they said they would outperform the S&P over a 5-year period. But Buffett said, no, you won't outperform him. I'll bet you $1 million you won't. So 5 years later, the S&P is up 8.69%. Protege's numbers are comical, according to Matt Taibbi. They came in with 0.13% gain over 5 years. Now, while they're collecting fees, of course. So the S&P, the dumb old S&P, beat the smarties at this hedge fund by about 8.5%. Without even any large fees. So you get to keep more of that money too. Okay, so let's forget about these hedge funds. So what about the safest kind of investments? Well, the city invests in government securities and corporate bonds. So they've got 1.8, again this in thousands, so 1.8 billion in bonds of various kinds. So start, keeping a mental tabulation here. We're adding now this is where all that 6.4 billion is coming from. We're going to see there's more money elsewhere, but that's where this is all going. So now the city's policy is to only put money into funds that are rated AAA by Standard & Poor's or A, lower A, by Moody's Investment Services. That's on page 48. So the question is, would a public bank in Philadelphia be safer, would it be a better investment for the city's money than government agency treasuries, which are considered the gold standard, better than the gold standard, for investments. But before we answer that, this is the S&P rating of the Bank of North Dakota. Just as an example, they got a AA minus for short-term issuer credit, long-term issuer credit, and short-term issuer credit is A minus 1 plus. Don't ask me why they do these ratings, but that's pretty high as their ratings go. So if you really want to look at the risk analysis, you also have to ask yourself, have any other banks failed in the community that the state bank is supporting? So it turns out in North Dakota there have been no bank failures in 20 years. Nationwide there have been 517 bank failures since the year 2000. So we've got all these hundreds of banks failing, community banks all over the place, but not in North Dakota. So this state bank is doing something right. So as we start talking about a public bank for Philadelphia, think of that too. That can keep the community banks afloat as well. You'll see the references on your handout. Okay. Oh, but one more thing about that last slide. As a matter of fact, all right, no, I'll talk about it a little now. So we're currently, the government is shut down, as you know. The United States government is doesn't have a budget. It's shut down. We're about, what, 5 or 6 days from a debt default, which would be a catastrophic thing. This has happened a few times in our history, but not recently, except one time I'll talk about in a little bit. But it did happen in 1979. People think we never defaulted. We actually did default in 1979, but only for $120 million, very little money, because there was a computer glitch. And for 6 hours, the government was in default for $120 million, 6 hours, not 6 days. We were sued. The government was sued by the people who own those treasuries, and they said, you didn't get your interest to us in time, we're suing you, we want penalties and so on. So the government said, okay, we want to keep good faith and credit, we're not going to fight it in court. So they paid the penalties and the interest. And ever since then, and since 1979, our credit rating has been slightly depreciated because of this. So don't let anybody tell you that if we go into a total debt default in a week, that it doesn't matter, because we're still paying for that tiny little default in 1979. So it does matter, and it continues to matter. Okay, so there's also, now here's other money. This is going to be now on top of the $6.4 billion. Philadelphia has these 8 separate agencies. They all have their own funds. Remember, again, this is in thousands, so this is 708 million and so on. And this is 2 billion on the bottom when you add them all up. So these are agencies that get to make their own investing decision. And they could say, as an opportunity, hey, you know, we want to put some of our money in a public bank too. You know, we don't want to put it in Wall Street banks. We don't want to put it in hedge funds. These are agencies that can decide on their own where to put money. So, you know, if Philadelphia turns you down, go to Redevelopment Authority or something. Maybe they have a different idea. So we have to start building this coalition between these different agencies as well as the City Council of Philadelphia. So that's 2 billion. Remember that number. All right, now this is a breakdown of what kinds of things the government activities and business type activities invest in, and again, those 8 separate component agencies that we saw on the last screen. This is from page 26. And here's that $2 billion number that was in the last slide. Now here's another $3.5 billion based on the government activities and business type activities. These are basically like enterprises that are in the public sphere and they have their own budgets. So you find a few interesting things in here. One of the things that comes out when I do these CAFR analysis in different states and cities, I find this a lot. There are treasurer's accounts. And they, for some reason, they have this huge pool of money. So here they've got almost $1 billion, $927 million. And they'll tell you, oh no, you can't put that into a public bank, it's restricted, it's a rainy day fund. Well, you know, it's raining. It was raining yesterday. It was, yes, it's raining a lot. It's hail. So it's time to free that money up. You know, Ellen Brown, who was the founder of the Public Banking Institute, she found $70 billion in a treasurer's fund, which was about 3 times the amount that California was in a deficit at that time, in debt actually. So they were 26 billion in debt, and she found 70 billion. She asked the treasurer, well, you know, why can't you use this? Apparently they get asked this a lot because they have a notice on their site that says this is a rainy day fund. You can't use it for municipal or state purposes. It's a treasurer's fund. It's excluded, blah, blah, blah. You know, laws are meant to be changed. So let's talk about changing some of those laws and putting that money to the public use. This is another interesting thing, which I find this a little comical. This is due from component units. That's this column, 69 million. And this is due from primary government right below it, 69 million. So why don't they just wash those out and call them 0? I thought that was amusing. All right, and then you've got, you know, accounts receivable, what they hope will come in, 490 million will come in. So, okay, you don't have that money yet. I'm not saying that this money is sitting somewhere in a drawer that you can put it into a public bank, but it is on the balance sheet, and they're counting it as assets of the city. So if they can count it as assets of the city, why can't we count some of that at least in a public bank? If you could take even 5 or 10% of this and put it into a public bank, well, you know, there's $5.5 billion on this one screen alone. And as we saw on the previous screen, there was 6.4, was it, on the previous screen? 6.9, but I'm going to get to that in a minute. All right, so I added up all of these enterprise funds, water and sewer, aviation, industrial and commercial development from page 31. It comes out to these 2 figures, and then remember they're derivative investments. Well, that's safe. And what could happen, right? Non-current assets, restricted funds, including that treasurer's account, another treasurer's account. And then there's what's called non-major governmental funds on page 123, which has 418 million, and it sounds pretty major to me. And then you've got the fiduciary assets. You know, when you go through these, there's hundreds of pages in these CAFRs. And they do these things, and I'll be honest with you, I'm not an accountant and I'm not a banker, so sometimes I get a little confused about this, but you know, it seems to me that they were giving a different figure for the gas works retirement and the municipal pension fund on this page than they were giving before when they had that 6.4 billion. So this is only about 5 billion, so it's 1.4 billion short. So, okay, fine. I'm going to take their figure at it. I'll take their word for that figure. And I put that down here. I just added up this page and this second line, and then from the previous page we have 6.9 billion. So that adds up to $12.4 billion. If it's 1.4 billion more, well then you've got $14 billion. If we start including state CAFRs or other counties, well, it's much more than that. These are not capital assets. There's no bridges in here, there's no schools in here, there's no roads, you know, nothing physical. This is all investable money in one form or another. So it's liquid assets and it can be invested. So you know, don't let anybody say, well, you can't sell a school. We're not doing that here. These are investable assets. So 12.5 billion, and I realize they have restrictions and so on, but some of these can be changed legally. Some of them can be, you know, the city council can decide we'll put some money here instead of there. They can decide that. So. Okay, so now what are we paying for all this great management that is not beating the S&P? The standard fund management fees, well, you all get broker fees every month. You probably have mutual funds, you know what they charge, 1 to 2%. So we're paying that kind of thing to brokers as well. There's trading costs, and sometimes these trading costs are on top of the fees of the funds. So you have to watch the fine print there. That can be additional cost. Then you pay reporting fees to JP Morgan because they run off a excess, what's called a municipal, City of Philadelphia Municipal Pension Fund Excess Return Report. I love the optimism of that title. So that's what supposedly is the report of the excess above the projection, but when I looked at it, it was below the 8% projection that they thought they were going to get. So it's actually a regress report, not a non-excess report. So what other fees are there? Well, this is a problem. These hedge funds don't like to disclose their fees. Matt Taibbi has written about this because all the cities and all the states that use hedge funds have this problem. Hedge funds say, we don't want to talk about our fees. And then they say, well, that's proprietary information. If people knew our fees, it would disadvantage the returns. It would squash the returns on the funds themselves. And Mike tells me that they actually have a law that says that you can't disclose the hedge funds legally what they're charging in fees. So that's a hell of a law. So we get to charge you a lot of money, and we don't get to, and you don't get to say how much it is. But a hedge fund typically charges 2 and 20. So they charge 2% for managing money, which is a little high to begin with. Then if they do make profits, they charge 20% of the profits. So you don't even get to keep all the profits they supposedly make, which they don't make because they're underperforming the S&P. So wow, that's pretty good racket. So now let's talk about a public bank instead, because that's probably looking more attractive to you at this point. Okay. These two charts actually came from the Center for State Innovation. I did slight modifications to them. I don't know if you look at it, you can probably tell where. But this is the existing system on top. I didn't change that. So this is what happens now. The taxpayer pays his poor taxes into the state government. The government invests in Wall Street. Wall Street goes wild. They go in the stock market. They do currency speculation. They do derivatives. Nothing could go wrong there. So this is whatever profits they make go back into the bank, not into the state. And the state gets a little bit of interest on their money that's invested in the bank, not a whole lot because interest rates are what, 1/4% now? So not going to get much there. Now here is the alternate system. It says state here, but substitute city for state. So we're talking about a city bank system. The taxpayer pays money into the city government. The city would invest money into a city bank. And now here's the part I added. Nice big colorful community bank. Because the city bank would a city public bank would support community banks and help keep them in business. They would act, at least under the Bank of North Dakota model, as a mini-Fed, backstopping all the loans, so that they would be able to provide money whenever the community banks don't have enough, so let's say to start a business or to create new mortgages or something. So then these state projects can also be private projects if it's coming out of a community bank. The profits of those, if it's a state project, go back, or city project, go back into the city government. And meanwhile, the city public bank would pay a dividend, which is a bit more than interest, because now the city is a shareholder of the city bank. They're not a depositor in the city bank, they're a shareholder, so they get dividends as any shareholder would get. So that's more money percentage-wise. So to take the example of Bank of North Dakota, they've been paying $30 million a year for 10 years in dividends. So $300 million over 10 years is not too bad for a state of 700,000 people. Okay. Now one more thing about the banks here. And remember, there were 500 bank failures, community bank failures, all the small banks, not the big ones, over the last 13 years, since 2000. Now in North Dakota, where they have this system, the Bank of North Dakota, the community banks in blue have a loan-to-asset ratio of about 75% since 2005 through 2009. Now that's the crisis year. So they're loaning out 3/4 of their money in assets in loans, whereas the other states that are comparable nearby are around 50, 60, this is 70%, Montana and South Dakota. But the main thing to remember for Philadelphia is a typical mega bank like JP Morgan has only a 31% loan-to-asset ratio. What are they doing with the other 69%? Well, we saw they're doing dividends, they're doing derivatives, they're doing mergers and acquisitions, they're doing wealth management. So they're doing all these other activities which really are not contributing to the community at all. So on the one hand, they don't contribute. On the other hand, they're not making loans either, because they're tying that money up doing these other things. So they're really not serving the community in multiple ways. So, you know, you got to ask yourself, why are you keeping your money there? All right, so learning from the example of the Bank of North Dakota, we saw this before. Remember these ratings. So we want to get that kind of a rating on the Bank of Philadelphia. Now there's another risk here which I put in there, that's key man risk. And the key man risk, you know, talking about JP Morgan again, yeah, you're already skeptical, right? Jamie Dimon is making millions of dollars a year. I think they cut his salary to 11 million, oh boy, poor guy. Because he didn't do so well last year, but he was making 20 million before that. So the last time I looked, the president of the Bank of North Dakota was making less than 300,000 a year. JP Morgan just paid about $1 billion in multiple civil fines for breaking the few laws that we still have on the books that are actually enforced against banks making rogue investments and deceiving their shareholders and so forth. So they paid $1 billion in fines recently, finally getting prosecuted years later. Bank of North Dakota, zero. Now they've been in business since 1919. They've never been fined. They've never been found guilty of any malfeasance. They've never been in a scandal. They've just served the state and they've grown the state. And they've done this for almost 100 years. So again, you have to ask yourself, which is a better bank to invest in? A big mega bank like JP Morgan, which we hope will continue to get bailed out, maybe we hope that, or the public bank. All right, so now here's what's going on in the rest of the country. Now this map comes directly from the Public Banking Institute. And you can see on here the two green spots, that's North Dakota, so they've got a bank. Now this striped green here is interesting. They actually have a public bank in the Chickasaw Nation, which is called Bank 2, because Bank 1 didn't do well, but Bank 2 is doing very well in Oklahoma. And they take all of the Indian Nation public money and they put it into this public bank. So we basically have 1.5 state public banks in the country. And 22 states, according to the National Conference of State Legislatures, are now considering some form of state banking legislation. And as we know, more municipalities, so the cities, are also considering how to reallocate those CAFR funds as well. Detroit and Stockton, meanwhile, are looking at their CAFRs and saying they're bankrupt. I wrote an article which you can see on Op-Ed News. My publisher is sitting in the blue sweater right here, Rob Call, called "Detroit is Not Broke." And you can read that and see that Detroit is actually not broke. So when we say no more Detroits, you take a little side journey there and see that there's actually a reason to see that Detroit, there should be no more Detroits, there should be no more cities saying that they're broke like Detroit, because Detroit's not broke either. They actually have money. And as I said before, Kevin Orr came up with $2 billion if he used the old GAAP methods that he's not using now. All right, so we know where the money is, and we know what to do with it. So let's just take one last look at the banks here before we decide whether or not to invest in them. So now the too big to fail banks, these top four, are now bigger than ever. In 2008, they had 43% of the assets of the country, which is pretty high, but now in 2013 they have 47.2. So all the banks except Citigroup slightly, they all grew in their assets because they were bailed out. And so now they're bigger than ever. So are they going to get bailed out next time? Well, no, actually there's a new policy. This is what I was talking about before. The FDIC and the Bank of England have come up with a joint policy, and they say as of December that the next time a big, too big to fail bank fails, what's going to happen is they're going to take depositor money, including state and city depositors, and they're going to turn it into bank equity. And they're not going to ask you. Turn it into what? Bank equity. In other words, you're going to be a stockholder of the bank. You used to be a depositor, now you become a stockholder. And this is because you're actually an unsecured creditor in the bank. And Rudy has made a great video on this, which I wish we had time to show, but you can go online and see it. 120,000 people have apparently. And it shows that unsecured creditors, including states and municipalities, they have no rights basically, because the first priority to repay a creditor is the parties that have derivatives. Now, as we'll see on the next slide, the derivatives are so huge that this plan, not only is it morally indefensible, but it's economically untenable. It's just not going to work, because if the government can't bail out a too big to fail bank, sure as heck the little depositors won't have enough money to do that either when these things go bust. So what you're going to have basically is equity in a failed bank, which is essentially bankrupt, along with the other shareholders who are all having their shares diluted, by the way. So if you're a shareholder in JP Morgan, you run the risk of share dilution when your depositors join you as shareholders. Everybody's going to rush for the exits, trying to sell their shares. The states, being some of the biggest shareholders, will have probably the most trouble selling them. And you'll be stuck in a bank which is basically headed toward bankruptcy, where you can't get your money out because you were a depositor, now you're a shareholder. And so your equity will be worthless and your deposit will be gone, and this is where we're going to be. So when we're talking about being fiduciarily responsible, everybody has to really think about this. Every treasurer, every controller, every public official who's got any influence over where their money is allocated and invested has to think about this possibility. Because if this happens, this is a Cyprus scenario, and it happened in Cyprus. If this happens here, you know, the first time it happens, there's going to be the mother of all bank runs. And it won't have to do with that one bank, it's going to be every bank. And then we're just going to trigger a collapse, which under this scenario is just going to lead to more forced bank equity and failing banks. And it's just going to be, you know, then we have to start talking about a different form of money and really radical changes, which I'm not here to talk about, but I could. Now, we heard banks compared to casinos in the beginning of this, but, you know, I was thinking about that, and I told Mike this. You know, that's really unfair to casinos. I'm serious. I'm tempted to write Steve Wynn because, you know, casino, you walk into a casino, you know what the rules are. They're not going to change while you're there. The rules are consistent. You know, if you go bust, if you go bankrupt in the casino, you get thrown out. You don't get bailed out, right? So what is this? This is worse than a casino. This is like you change the rules in the middle of the game, and if you go bust, the casino says, that's okay, here's some more money, gamble some more. That's not sustainable. No casino can stay in business that way, and neither can any government. So it's worse, it's bad for casinos or reputation. I feel we really have to defend the casinos here. All right, now there's one last chart I want to show you before I wrap up. This is from the Office of the Comptroller of the Currency. Now it's very small type, but I'll just give you some highlights on this. I know. But when you get the hard copy of this, it'll make a little more sense. So this is their chart, and they show the top 25 banks. And now we're not in the thousands anymore, we're in millions. So now we have to add 6 zeros to the end of everything. Okay, so when it says the total derivatives up here, which is 69 million, it's actually 69 trillion. JP Morgan alone, $69 trillion in derivatives contracts. Their assets are just, on this chart, which is a bit old now, were 1.8 trillion, so okay, they 2 trillion, who cares? So they have 2 trillion in assets, 70 trillion in derivatives. If even 5% of that goes bad and they're liable for that somehow because they're on the wrong side of the trade, they're wiped out. Heck, even if 2% goes bad because they won't have those kind of assets. And remember, banks tend to go bad all at once. So if they all go bad at once, this comes out to $12 trillion in derivatives contracts. So that's like most of the assets of the country, basically. So there's 12 trillion in assets from the banks, but there's 222 trillion in derivatives contracts. So this is just from the top 25 banks, but the top 4 or 5 really have most of that anyway. So $222 trillion nationwide in derivatives. And I've read on various sites, it depends on who's counting, but it's anywhere from 700 trillion to 1.2 quadrillion, new number, in derivatives contracts worldwide. That's what we have worldwide in derivatives contracts. So even if they're counterbalanced, and I know they're hedged and one goes down, the other goes up, and we've seen how well that works. And even if they're not on the hook for all of it because there's third parties and all of that, I understand all that. But there's enough exposure in the bank itself that even if a small portion of it fails, these banks are going under. And there's no governmental authority, there's no power on earth that can rescue them. Now remember, public bank is not under FDIC rules. So a public bank does not have to contribute, the FDIC does not have to bail out a public bank. It's a DBA, it's doing business as a city or a state. So it's only, its asset base is basically the tax base of the city or a state. So as long as the city or state exists and they continue paying taxes, that bank won't go under, even if every bank around it goes down, and even if the FDIC, which only has $25 billion, goes broke, you know, a public bank is still going to be there. So we have that option. So this is the beginning. I hope you'll investigate the CAFR and take a look at the numbers and let me know if I'm wrong, and then we'll make this happen. Thank you.
Great job. Great job.